Greetings, Jonathan Camarda, your humble CIO. I've given you the gift of missing me here for a few weeks. As the kids say, it's been a minute since I've had the privilege of talking to you good people. So let's just get right to it. No nostalgia necessary. Markets have continued to march upward, as you have probably taken note if you look at your statements and just reading the Wall Street Journal or however you get your information. So momentum has been the key. Technologies now represent over 30% of the S&P 500, the highest percentage since the early 2000s, and utilities at their lowest weighting in the S&P 500, again, over the last 20 years at less than 3%. So again, and that has really gone in sync with what we've seen the last 5 years. Technologies have crushed S&P 500 and all other sectors have underperformed. So technologies have carried the market over the last 5 years. Now we look at the last 13 months, right? The sectors that, again, we've been more heavily weighted in, technologies, discretionaries, and communications have outperformed with all other sectors underperforming. Now, the weakest sectors over the last year or so have, of course, been energy and utilities. Real estate there as well, but not nearly as weak as those aforementioned two. All other sectors with the top three that we already discussed, certainly the best performers. So what does all this mean? I mean, the run we've had since early November when rates came back down, right? And we'll get to that in a moment there. For all you fixed income lovers out there, be patient. But what we're looking at, the run that we've had since early November, we haven't had a 5% pullback. The longest time we haven't had that in a run up since pre and post vaccine rallies in 2020 and then 2016 mid-year post Brexit rally there. So essentially, we're probably looking for a breather at some point. So you might be thinking, yeah, so taking money off the table? Well, not that easy at this stage, right? Because every dip has been bought. And we are in that Goldilocks perfect Bermuda Triangle, if you will, elixir of where the Fed, when they stop hiking and before they start to drop rates, it is generally a good, beautiful, perfect middle of the fairway time for the market to go up. And what we've seen, right, with the recent Fed, what they said coming out, that they weren't going to reduce rates just yet. They're looking back a little bit now. So those soft landing folks this year, the Pollyannas, they expected 7 rate drops this year, probably over the top on that. 3 to 4 is the higher probability now because the economy is still chugging along pretty attractively here, right? We just saw the CPI number, which we'll get to that. And so it is a perfect Goldilocks because earnings, right? Over 70% of earnings have come in with beats, and those stocks have been rewarded. So again, we are in that perfect situation between the Fed moves and that delineation of when they change, how they're actually treating rates. Good time for risk assets. So again, we've been exposed in that way. We look at the National Association of Active Managers, and they were underweighted early January. We stayed overweighted, and it's paid off as they've now become overweighted being over 90% in equities on the active side there. And so again, because we do understand the macro backdrop of how markets react during these times. Now, I will say this, technologies actually have made up the 20-year, from the early 2000s where they're outperforming the S&P, making all-time highs. Remember, it took so long after that drop during the tech bubble that the technologies really, really have made up some ground. Now, some of the concerns out there, mid-cap and small caps, of course, have not enjoyed the same returns. And of course, we've been very underweight in those areas over the last year and a half. Now, during the rate drop from November, right after October, that spooky part of the year, into early November, small caps, mid caps had a nice rebound versus large caps. More docile in early January into early February, now outperforming over the last week or so, but really not a whole lot of heft there. Now, when you look below the surface, the Russell 2000, the small cap index everyone looks at, most of the companies in there, a lot of financials, aren't even profitable. So it's kind of a misnomer to really look at that as a beacon. But again, we'd like to see some participation there as far as the strength on the foundation, but large caps doing very well. Now, when we start to look at the macro backdrop, fixed income and currencies, we've seen rates, again, that yield curve, right? We talked about inversion, right? A little seasick there, a little vertigo. Well, the 2-year and the 10-year, where the 2-year was a lot higher than the 10-year, that has now narrowed a little bit, not because the 2 years come down. So short-term fixed income, we've been overweight to take advantage of those rates not going up. But on the longer end, they've come up. The 10 years come up from like 3.75 to about 4.25. Still less than the 2 year, but it's narrowed. And that's why we've been a little bit more underweight on the long term of the curve, right? Because again, as rates go up, those longer term bonds have gone down. And we've seen that this year. And yet active capital preservation, which is diversified across multi-asset classes, making income beyond fixed income, has not suffered that fate. Again, because we stay diversified well beyond just your standard advisor 60-40, checkers type allocation. Not to get too in the weeds there. Now, as we go into currencies, again, this goes hand in hand with fixed income and then the yield curve. That U.S. dollar been working out again and has had strength versus your euros, your yens, your CADs, Canadian dollar, your AUDs, Australian dollar. Okay, I'll stop. Anyway, the dollar's been going up. And of course, rates have gone up, like I said, on the long end of the curve. That makes sense. Fixed income on the long end, we've been underweight. And then equities themselves, though, the large cap equities have not suffered even with the dollar strength. And the reason is because the Fed has their foot off the gas pedal. Now, speaking of the Fed, let's get to the CPI, right? What are we talking about the CPI? Well, CPI came in hotter, right? We had that ugly down day, and then the markets rebounded. So you say, why? Well, because the CPI, not to rhyme, has an overweighting to what they call rent calculations and the cost of housing. The problem with that, it's a lagged indicator going back months, even though we have everything with ChatGPT, all the information fresh, being a little facetious there, but it's a lagged indicator. So those increased costs lift CPI. We think the Fed understands that when you lift that curtain, it is a misnomer. It's not as hot. And the Fed uses more of the PCE. I'm going to get too acronym heavy here. The PCE, though, which underweights those housing costs. And that number is right in line with where the Fed wanted things to begin with. So now where does that leave us on dropping rates? Well, they're still probably not looking because we do have decent economic strength until later in the spring, May and June, not March. What does that mean? The market has some runway. So on a risk management standpoint, yeah, if things really start to hit the fan, then we might have to make some adjustments. But again, you can see buy the dip has been the most opportunistic or remaining in during the dip if you weren't in to begin with, but not selling the dip has been the winner thus far. And with the macro backdrop, we are leaning towards that, but always with a vigilant foot near the brake pedal if things start to fall apart, as you know. Now, with that being said, a caveat as I kick it off to Lou and the PWA's private wealth advisors, as I talk to my clients, your individual situation trumps, no pun intended, in an election year, the actual models and the macro backdrop. In other words, if your situation dictates, that is number one because it's your money. And again, it's you earned it. So we want to make sure that that is sculpted to your idiosyncratic situation. So with that being said, I'm going to kick it over to Lou. Stay frosty out there. We'll continue to stay vigilant and watch these 10 screens I got going here. Till next time.
Hi everyone, I'm Lou Vrcelj, Personal Wealth Advisor, here to discuss issues you may want to consider when reviewing your cash flow in the upcoming quarter. Cash flow conversation is universal and critically important to health and well-being of your financial plan. Perhaps income streams have changed, which can affect your debt and taxes. Maybe your essential discretionary spending has experienced some volatility, which can affect your debt, even goal funding. Or your saving goals have changed, which can affect your discretionary spending. Whatever the case may be, we've shared a handy checklist called What Issues Should I Consider When Reviewing Cash Flow? It's an optional resource covering several areas that can help shed light on anything we may want to discuss and revisit together on our next call. That's all for this week. Please remember to like, subscribe to our page, and thanks again for watching.